I'm Dan Murphy. Straight to your headlines this hour. First, it is make or break week for India on the tariff front, with just days to go before higher US tariffs kick in. Foreign Minister S.J. Shankar saying they are still talking but will not back down on red lines. Fresh off its GST overhaul, Prime Minister Narendra Modi saying there'll be more reforms in the coming months as India looks to boost manufacturing, jobs and become a bigger contributor to global growth. And India's central bank greenlighting a bid by Japan's Sumitomo Mitsui Banking Corporation to buy an additional 4.9% stake in Yes Bank, taking the stake to just shy of 25%, one of the largest M&A deals in India's financial sector. And OpenAI looking to further expand its footprint in India with plans to open an office in the country to tap the growing AI market there. A warm welcome to the program. Great to have your company this hour. And we begin with a live look at how Asia markets are trading right here, right now. And you can see it is a day to the upside today, kicking off a fresh trading week on a bullish note off the back of what was, of course, optimistic commentary about potential cuts to come as soon as September from the Fed Chair Jay Powell in Jackson Hole. U.S. equity markets also moving on up higher. And as a result, the translation for Asia is green on screen. Right now, we're seeing Hong Kong's Hang Seng and the TAIEX leading gains, better by around 2% as we speak. The SET index and the Shanghai Comp also catching a plus 1% bid here. But broadly, we are seeing markets very firmly in positive territory. As I mentioned, U.S. equity markets closing sharply higher on Friday, with the Dow actually sitting at a record high now. Markets rallying on the back of Fed Chair Jay Powell's highly anticipated speech in Jackson Hole. He opened the door for a possible rate cut at the upcoming meeting, but of course did not fully commit to it. The Fed Chair warning of the tariff impact on consumers and also saying that policymakers will have to wait to see the macro indicators to make a more informed decision.
The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem.
Chair Powell there. Meanwhile, the Indian market's coming online in about 45 minutes' time. Here's what Nifty futures are indicating right here, right now. And you can see the major markets perhaps not expected to follow suit in the same momentum that we're seeing roll out across Asia right now. GIFT Nifty futures down by 0.2%, sub 25,000. But of course, still early days. There's still time to play catch up. Let's watch and wait to see what happens as the market trading gets underway. Meanwhile, talks between the US and India are still underway, according to India's foreign minister. This despite a visit by US trade negotiators to New Delhi, initially set for this week, being called off. Jay Shankar said India has drawn red lines in those negotiations, which will be, quote, maintained and defended. He also addressed Washington's concerns over India's buying of Russian oil.
Negotiations are still going on in the sense that nobody said the negotiations are off. I mean, and people do talk to each other. I mean, it's not like there's a kutti there. So look, there is what happens is we have red lines in the negotiations. We have to be clear as to red lines by definition are lines to be maintained and defended. Keeping that in mind, see what we get. And frankly, where we are concerned, the red lines are primarily the interests of our farmers and to some extent of our small producers. In 2022, there was deep nervousness because oil prices went up. There was great nervousness, international nervousness about the price of oil. And there was there were a set of conversations with different people in the American administration at that time that if India wanted to buy Russian oil, that's fine by us because it will stabilize the price of oil. And by the way, those, after January, there were no conversations with the current administration saying don't do that.
Meantime, US Vice President J.D. Vance justified those secondary tariffs on India, saying the amount of levies on China is also high at 54%. Beijing is the largest buyer of Russian oil ahead of New Delhi. Vance told NBC's Kristen Welker that the Trump administration is talking to China as well to end the war in Ukraine.
I hear what you're saying about India. China is actually the largest buyer of Russian oil.
They're close. They're about equal.
Why no sanctions on China?
Well, obviously, we have a 54% tariff on the PRC right now. So we've already applied pretty hefty sanctions on the Chinese. And we've had a number of conversations at all levels of government to try to encourage the Chinese to be better partners in bringing this war to a close.
J.D. Vance there. Meanwhile, India Post ceasing US-bound high-value orders starting today ahead of the additional 25% tariff that take effect on Wednesday. The Department of Post saying it's suspending booking and transmission of all mail except letters, documents and gifts worth up to $100. Other carriers have also flagged challenges, saying they can't move shipments without clear mechanisms for duty collection. Reuters is reporting that Amazon is pushing New Delhi to relax foreign investment rules. The US retailer is doing so to buy products directly from Indian sellers for export. Right now, Amazon and Walmart's Flipkart can only run marketplaces, not stock or sell goods. It's a policy designed to protect small shops. Amazon says an exemption would help local sellers go global, but retail groups strongly oppose. With the government yet to decide, the issue remains a big sticking point between India and the US as they also seek to negotiate a trade deal. Up next on the program, Indian Prime Minister Modi touting the reforms done in the last session of Parliament that just wrapped up and also promising to do more. We're going to talk about one reform in one such sector that India is looking to advance. Stay with us. You're watching Access India. We're back in 2 minutes. Welcome back to the program. As ties with New Delhi remain strained, President Trump nominating longtime aide Sergio Gore as his pick for US ambassador to India. Gore currently runs the White House Personnel Office and would also serve as envoy for South and Central Asia, if confirmed by the Senate. Right now, New Delhi does not have an ambassador from the US, only a charge d'affaires. Well, Meera Shankar is the former Indian ambassador to the United States. She joins us live now. Ambassador, a warm welcome to the program. Thank you so much for being here. First, I wanted to begin with the state of India-US relations, no doubt something that you've been following very, very closely. You previously said that these relations are, of course, critical, but characterize where the relationship stands today.
Well, I would say that relations are strained and that there has been an erosion of trust in the way that President Trump has used tariffs, not just as a trade policy instrument, but also to push geopolitical objectives or to determine the direction of India's policy, about which India is very sensitive.
Ambassador, these certainly aren't normal frictions between two powers. I put to you what J.D. Vance told our colleagues in the United States. It seems as if that this relationship is sliding backwards. Your reaction to that?
It is, but India and the US have been through more difficult times after, for instance, the nuclear tests in India, when a whole range of sanctions were imposed. And we weathered those. So my hope is that the areas of convergence will override, let's say, the areas where there are differences, and that the two countries will be able to eventually sort these out in a more rational manner than they are doing today.
So let's talk about the pathway forward here. It seems as if trade negotiations, of course, remain stuck ahead of this really critical deadline coming up this week. President Trump seemingly not budging on these enormous tariffs that are about to be levied on India, up to 50% on Indian exports. How damaging, in your view, is that going to be for India's economy and broader trading relationship?
Look, it will be very damaging for the broader trade relationship with the US. But in terms of India's overall economy, we are not such an export-led economy, let's say, as China or many of the other Southeast Asian countries like Korea or Japan. Much of our growth comes from domestic consumption and domestic investment. So I think the impact will be there. It won't be good, but it'll be limited. Assessments have put the likely impact at between 0.5 to 0.6% of GDP. Predicted growth this year was about 6.5. So we are looking at perhaps a 0.5% reduction in the growth. But overall, the economy will continue to be robust. And I suppose if tariffs really kick in and talks don't go anywhere, then India will look also to diversify because, I suppose we're not just going to sit back and say, oh, the US has put tariffs, so, what do we do about it? I would hope that we accelerate our free trade talks with other areas, including the EU. We have signed one with the UK and with Switzerland and some of the European countries. And I hope that now our talks with the EU accelerate. And there have been some suggestions that India should also join the Trans-Pacific Comprehensive Trade Partnership Agreement. But I don't think that on that as yet there's any decision or agreement in India, but certainly there are 2 or 3 free trade agreements which are under negotiation. And my hope would be that these would accelerate. So we would look at trade diversification and at other economic partners if the talks with the US don't go anywhere.
Ambassador, just to challenge that perspective, of course, a more unilateral approach might pay short-term gains for India, but this is a country that cannot essentially isolate itself from the rest of the world. It has to do business with the United States, the Trump administration, and the world's largest economy. So as it stands right now, given the tariff threat that we see coming from this White House, what's your message to those US policymakers when it comes to doing business with India? And do you believe that India's red lines will have to shift here? Compromise will need to be found in order to get a deal done and to ensure that those 50% tariffs don't hit India's economy in the hardest way?
Well, I think at the moment, there are carve-outs. So, for instance, pharma and electronic products are outside tariffs. So those exports will continue. There are other products which may be outside tariffs, and those will continue. And we would continue our efforts to try to find a solution with the United States, which is reasonable, which also takes into account India's sensitivities. I think for a democracy like India, where there are many, interest groups at play, especially the agri sector, where there are 50% of our population still employed, I think we can't really allow that to hit turmoil, because these are subsistence farmers who eke out a livelihood with 2.5 acres. And if the shift from agriculture to industry has to take place, it will take place gradually. Unfortunately, it's not been happening as fast as it should, but that's the reality today. So I don't see any government being in a position to really compromise on agriculture or dairy across the board. But having said that, there are products that we buy from the United States. And in the agricultural sector, dried fruits, apricots, apples, and so on, and edible oils. So I'm sure that there is scope to purchase more. So as I said, a reasonable compromise perhaps would be workable, but the expectation of wholesale opening of India's agriculture and dairy sector, I don't think that is going to happen. And, when we see that the United States has not forced the EU to open its agri sector wholesale, and the EU still has restrictions on genetically modified products. And so also with Japan, I think the US, in its deal with Japan, has got Japan to open its rice market, which it imports in any case, it imports rice, but not the agriculture sector wholesale. So I would imagine that it should be possible not to single out India for a harsher, more differentiated approach, as we see also in the oil sector, where China is the largest importer, but there are no sanctions from Russia. Then the EU imported products worth $67 billion from Russia last year, more than India, including India's energy imports, but no sanctions on the EU. And the US is also importing strategically critical minerals from Russia, including uranium hexafluoride, palladium, chemicals, fertilizers, and so on, very minuscule amounts. But an American expert explained that there is a critical dependency of the US for import of these products, when there's a critical dependency of India for accessible and economical energy imports. So I think this is what really grates in India. You can't single out India for a harsher approach than you have adopted to all your other friends and partners. And therefore, we have to read the tea leaves, Is it really this issue, or is there a personal pique over something, or what? It's a bit of a puzzle to Indians why we are being singled out.
Well, Ambassador, expand on that for me, because the criticism on the American side is that India has been purchasing this Russian oil and funding Russia's war machine. Now, I've spoken with India's petroleum minister in the last few months. He made a spirited defense of India's buying. At the same time, we've also just heard from S. Jaishankar in the last 24 hours. He has also said that it is in the national and the global interest for those Russian oil flows to continue. Do you think India is being being treated unfairly here? And if so, what is the pathway forward on those Russian oil purchases? Is it time to cut the losses here, step back from buying that Russian oil and find alternatives? Or would you advocate for the government to continue making those controversial purchases?
Well, I don't want to double guess what the government is going to do. But I think at the moment, there is no plan to halt purchases. But talks with the US are continuing. US talks with Russia have started, and the US is talking about investments in Russia, about trade with Russia, about oil investments, about investments in critical minerals. So it does appear to us to be a little precious to put pressure on India at a time when you are talking about opening up, when Europe still has carve-outs for Hungary, Slovenia, and some other countries to import Russian energy. And total European imports from Russia last year, in 2024 is what I'm talking about, was still more than imports that India had from Russia. So is Europe funding Russia's war machine? Is China funding Russia's war machine? Because they bought $10 billion worth of imports, energy imports, more than India did last year. And even if India were to stop and these purchases were to continue, do you think Russia would be financially squeezed? Of course, it would hit our relationship with Russia, which is important, which has been a steady partnership over many years, but economically very thin. Till we started energy imports. At the moment, it's unbalanced because, we import a large amount of energy from India. Russia imports very little from Russia, and Russia imports very little from India. So there are issues in that relationship, but it's been a steady partnership and they've been a good strategic partner. And there are legacy issues in the defense sector. So nobody in India is going to say, because the US is pressurizing us, we're going to put our relationship with Russia at stake also.
Ambassador, just before I let you go, you heard earlier that Trump has named Sergio Gore as the new ambassador for India. Do you think he's the right person for the job?
Well, I don't really know him. I've read about him. He's really not been a diplomat before, but he has President Trump's ear. I think what has struck people in India is a bit strange that he'll also be special envoy to Central Asia and South Asia. So is President Trump looking at India through the prism of somehow weaning away Central Asian oil from its direction towards Russia and China, and trying to get an outlet through Pakistan, which was the old game in Afghanistan? Are we going to see a replay of that? I think there are questions which India has, and I think these also will need to be answered as we go along if the hiatus in the relationship right now is to be resolved by both countries.
Ambassador, we'll leave it there. I appreciate the conversation this morning. Thank you so much for coming on the program. Looking forward to speaking again very soon. That's Ambassador Mira Shankar there, the former Indian ambassador to the United States. Thanks again, ma'am.
Thank you.
Meantime, India's Prime Minister Modi speaking at the Economic Times World Leaders Forum and talking about timely reforms and also promising more. Last week, the Indian Parliament wrapped up its monsoon session and cleared key bills, including one on critical minerals.
For us, reforms are not a compulsion. They are not crisis-driven either. Instead, it is our commitment and conviction. In the monsoon session of the Parliament, there was an overhaul of mining-related laws. We also reformed the shipping laws that were there since the colonial times. These changes will promote India's port-led and blue economy.
And staying with critical minerals, the MD of India's Bajaj Auto, Rajiv Bajaj, telling CNBC TV18 that access to light rare earths is improving. He says this will allow the company to ramp up deliveries of its scooter and electric three-wheeler at scale. Bajaj added the process began even before the recent India-China exchanges, but momentum is building now. He cautioned that overall rare earths supply remains tight. Meantime, China is tightening controls on rare earths and is now including restrictions on imported minerals. Elaine Yu joins us live now with all of the details. Elaine, what have you found?
Hey, Dan. So the government has rolled out sweeping new rules that gives China a lot of visibility, real time, and control over the entire supply chain of rare earths in the country. And what's new is that it's not just controlling what comes out of the mines in China, but what flows into the country for processing. And we know that China is home to about half of the world's reserves. And where China has the greatest dominance is the processing. And China also imports significant amounts from Myanmar for processing and exports. And according to the new rules, China will control the total volume of what's being mined and processed. So companies will follow strict production quota, and they must report monthly data to a new tracing system of these product flows. And these rules are also coming at a time as Beijing has recently said it is cracking down on alleged smuggling of these strategic minerals. Authorities in recent weeks have said a foreign contractor used China's postal system to smuggle rare earths, but they didn't say which country it was. But there are other reasons for tightening this control as well. An industry insider told Caixin, China's business news outlet, that the quality of domestic ores have declined significantly after years of domestic mining. And so producers have turned to importing to fill these supply gaps. And these imports have fueled China's smelting capacity, and they've grown rapidly, which makes tracking and oversight really difficult. Now, the rules didn't spell out what the quotas are, but these rules do come as we've seen China alternately tightening and lifting export controls over rare earths. So, for example, speeding up approvals as the U.S. made concessions during the trade talks. But this is a consolidation of control over a sector that is critical to global manufacturing, and other countries will be watching very closely. And it could energize efforts by countries like the U.S., Europe, or Japan to build up these alternative supply chains. But of course, it is very difficult to build up the complex refining and processing capacity that comes with huge environmental costs and can take many, many years to develop. Dan?
Elaine, really interesting. Thanks for bringing us the latest. Up next on the program, India's ban on online games involving real money is making the industry jittery. We're going to speak to the CEO of Nazara Technologies right after this short break. Stay tuned. Good to have you with us. We are counting down to the market open in India. Here's how we're currently shaping up. And with regards to the open, well, the expectation is that we will see a follow-on from what was a really positive Wall Street session. Asia shares also moving higher, but right now Nifty futures are actually pulling lower, down by around 0.2%. So watch that space when trading gets underway in just under 15 minutes' time. Local media reports saying Indian fantasy sports platform Dream11 is in talks to exit its $41 million jersey sponsorship with India's cricket team. It comes after the government banned real money online games. The new law blocks promotion or advertising of platforms providing such games, putting Dream11's association with India's Board of Cricket Control at risk. Any exit must be mutual, and the Cricket Board says it will comply fully with the law, leaving limited time to find a new sponsor ahead of the Asia Cup on September 9. Meanwhile, shares of Nazara Technologies, the only listed player in this space, seeing weakness last week. Nazara owns a 46% stake in Moonshine Tech, which stopped offering online money games, including PokerBaazi last Friday. Other platforms like Mobile Premier League have also paused their real money offerings following the ban. You can see the stock fell around 17% last week. Nitish Mittersain is the CEO and Joint Managing Director of Nazara Technologies. He joins us live now, first on CNBC, to react to what's happening, not only in the stock, but also with this policy. Nitish, welcome to the program. It's great to have you. We now see the shares trading at a record low. You came out with a statement at the end of the week saying there was no direct exposure to real money gaming within the business, but why do you think the shares have reacted so strongly to this policy now unfolding in India?
Sure. I think it's a pretty surprise policy because, the industry was not really aware of it, and it came out last week and was executed extremely fast. Nazara is a very diversified gaming platform with 80% of its revenues coming from international markets, while its home market, which is India, is a very interesting growing market for us. We are diversified into real money gaming, but also into esports and casual gaming, with 100% of our revenues actually coming out of not including real money gaming. The only thing with real money gaming is we have an investment in PokerBaazi, which is India's largest online poker platform. And it's about $100 million investment, which is at risk, and which is why you see the stock reacting negatively to this news flow.
So has the market misunderstood your business, or are investors right to be worried?
Yes, I think, of course, there is a risk to the $100 million investment that we have in PokerBaazi, and the company will adapt itself. The PokerBaazi business will adapt itself to the new regulations. But our overall revenues do not include any real money gaming revenue. So our revenues or our profitability would not get impacted at all. That's a clarification we also put out to the stock market. But right now, there's generally a lot of surprise and negativity towards gaming in general in India.
As I understand it, that exposure to PokerBaazi is at about a 46% stake in both equity and convertible. So are you preparing now for a full write-down?
I think we are going to evaluate over the next couple of weeks what kind of pivot the business can take. And, of course, there probably will be some level of write-down. But whether that's full or that's 70%, we will have a discussion with our auditors and then take a final call.
So you're considering your options. If you do write off that investment, how would it flow through to P&L? Let's say you went ahead with a 100% write-down, take it off the books. What is that going to mean?
I think our revenue and EBITDA will not get impacted, but below EBITDA, we will take an impairment. So the PAT will be negative to that extent.
And what would be your preferred course of action at this point? If you had to make a decision right now, would a full write-down make sense?
Nazara generally follows a conservative policy of accounting. So we will do a conservative accounting to the extent our auditors advise. I think that's really the plan. But I'd just like to take a step to, explain a bit about the Indian gaming industry since we're talking. It's a $4 billion a year industry. About 80% of it comes from real money gaming. But it also has 500 million gamers, and everyone's playing on their mobile phone. And while the short-term impact on real money gaming industry is going to be, felt strongly by the industry in general, I think there's a huge, India's probably going to be the largest growing market in gaming over the next 5-7 years. And I think we are something very excited about as India's only listed gaming company. I think there's a lot of opportunity we have. Also, the regulations that have come out while they were negative for the real money gaming side, they were extremely positive for esports and casual gaming, both areas where Nazara operates and is actually a market leader in the esports space. So I think it's kind of a bittersweet regulation for us. We're still very excited about the gaming industry in India.
I'm going to ask you about where you can pivot and find new opportunities in just a moment. I just wanted to draw a line under where we stand when it comes to real money gaming in India. Do you think this bill effectively ends that industry, full stop, draws a line under the future of exactly what we will see in that space? Or is there some kind of chance that this could be turned around and may actually be reversed? What's your take?
Industry associations may consider some kind of, legal attempts to recover. But at least from a Nazara perspective, we are prepared for the worst and we will approach it accordingly. Again, our diversification helps us, but I think the government has taken a very strong move and there's a very high chance that this will stick.
Fine chance it will stick. Okay, so talk to me about where you pivot from this point on. You mentioned there's opportunity in esports. Talk to me about your current exposure and what plans you're putting in place now to not just reverse the decline that we've seen in the stock, but firm up investor confidence in the business with wherever it is that you decide to start making new money.
Yes, again, it's very important, again, for me to repeat that 100% of Nazara's revenue and its EBITDA does not come from real money gaming, which means that with this ban, our revenues and our operating profits do not get impacted at all. I think Nazara is probably best placed as India's first and only listed gaming company to take advantage of this disruption and grow stronger and bigger. So I really don't think we need to pivot. We just need to double down on areas that we are already very strong on. We own gaming studios that produce fantastic IP all over the world, including India. We are market leaders in esports in India. And I think just pushing that along where we are doing, we're also a cash-rich company. We are a nearly no-debt company with about $100 million of cash on our balance sheet. I think we are probably best positioned to grow with this business in the years to come.
So what businesses right now are best positioned to drive growth over the next 12 months or so?
A lot of our core gaming IPs, Animal Jam, Kidopia, the Love Island game, we have a lot of such gaming IPs that are not only doing well in India, but also globally. This year we've just recently launched Big Brother. We have a license for, many other IPs. So I think we have a full roadmap this entire year to be launching new games in India and globally. We've also launched something called Nazara Publishing, where we are partnering with global game developers to launch their games in India. And our local strong partners want to become even more important with the new regulations in place. So I think that's something that's also exciting us quite a bit.
And of course, you mentioned the esports opportunity as well, which is perhaps an area where you can expand. Just with regards to the long-term strategy in India, has this forced you to perhaps review what's happening inside the country and look globally for new sources of growth? You mentioned there's an opportunity around the world. Esports is, of course, growing in interest. Do you see the opportunity outside of India or inside India?
Today, Nazara's revenues, 80% come from outside of India and about 20% come from India. So we're already a fairly global company in that sense. I think India is the future growth market for us. The next 5 years, we will see, the fastest growth in the world in terms of gaming in India. And I think we will continue to double down on India as a gaming market while expanding our business globally.
And just finally, when do you expect the share price to recover? Are there any options that you're considering now to firm up investor confidence, a buyback maybe, a dividend, or any other shareholder-friendly measures to restore confidence and trust after what has been a very sizable decline off the back of this bill?
Yes. Our Q1 results were announced recently with 100% year-on-year revenue growth, 90% growth in profitability. So I think the numbers are looking good. We also announced a split of our shares as well as a 1:1 bonus. I think some positive action has already been taken. In terms of time frame of share recovery, I've learned being public for the last 4 years that short-term price movement is very difficult to predict. And it's also not something we work towards. We've been a company around for 25 years, and we always have the mid to long-term horizon in place, and we've always created value for shareholders in a slightly longer time frame.
Okay, Nitish, we'll leave it there. Really appreciate you coming on today to explain what's happening with this policy and the impact on the business. That is Nitish Midasane there from Nazara Technologies. Thanks again. We'll speak soon. Moving on now, and markets in Mumbai will come online soon. We'll be back with a look at the top movers right after this short break. We're back in 2 minutes. Welcome back to the program. Straight to the wall for the pre-open in India. Right now, the Nifty 50 on your screen, better by 0.32% as we speak, but still sub 25,000 on the index. The rupee at 87.34 against the greenback right now. A quick check on shares of Reliance Communications for you as well. You can see here on the move in the market as trading gets underway. Last traded down 1.1%. India's federal investigating agency, the CBI, filing a fraud case against Anil Ambani and Reliance Communications after the State Bank of India alleged losses of 30 billion rupees. Searches were carried out at Ambani's Mumbai home and company offices. Ambani denies all charges. The agency says those funds were misused and diverted. Meantime, Japan's Sumitomo Mitsui Banking Corp getting an RBI nod to buy nearly an additional 4.9% stake in Indian private lender Yes Bank, taking the total stake of SMBC to nearly 25%. The regulator also ruled SMBC will not be classified as a promoter, easing compliance. SMBC had earlier agreed to pick up 20% for $1.6 billion. That is India's biggest cross-border banking deal. Shares of Yes Bank last traded up 4.77%. And a check on Indian government bond yields right now as well. Last week, news of consumption tax restructuring sparked a sell-off in the bond market. Investors, of course, concerned about the cost of the goods and services tax overhaul that the government might have to bear as well. So right here, you can see the 10-year at 6.53 this morning. Live now to Prashant Singh, he's a senior portfolio manager of EM debts at Neuberger Berman, joining us with more insights on what's moving these markets and what to expect in the week ahead. Prashant, it's great to have you on today, and I wanted to kick it off with what we're seeing with Indian bonds right now as well. No doubt you were following this really closely last week, quite a significant move to the downside. You see some value there, but maintain a cautious bias. Take me inside what you're seeing in the bond market right now.
Yeah, good morning, Dan. Thank you for having me here. So, yeah, as you rightly pointed out, there has been some concerns on the Indian bonds over the last week or so, as the news about the higher or the reforms in the GST taxes that has been coming through. So, but we need to take a step back. This year, Indian government bonds have been one of the best performing bonds in the broader EM world. Some of our topics in the EM portfolios as well. And we have seen now starting to see a bit of a consolidation starting to come through. Some of it is simply down to the fact that the central bank has moved back to a neutral stance. They have indicated that the hurdle rate for further rate cuts will likely be higher. And then there are some concerns around the fiscal trend is also coming through, primarily because we are indeed seeing some growth headwinds coming through. We are so from trade tariffs, from slowdown in external demand. And then we are also seeing that some of measures to address these growth headwinds might require more heavy lifting from the fiscal side. So from a GST reform perspective itself, we do see an impact of around 0.3 to 0.5% of GDP that might be coming through. And market is simply adjusting to these facts. So lower expectations for more rate cuts, probably some slippage on the fiscal side, some withdrawal of liquidity. So all of this is starting to cause at least some pullback of optimism in the market. And that is primarily explaining what the pullback in bond yields are indicating here.
Okay, so Prashant, if there is value here, where do you see the dislocation? Where do you want to be exposed across the curve? Because, of course, it's not just the domestic policy that's influencing the shape right now. It's also the threat of higher for longer tariffs as well, as we see this stalemate playing out between India and the United States.
Yep, so the value is just now starting to get built back into the curve. So we have to take into account that Indian government bonds are not necessarily a tactical play. The capital gain taxes are high, the hedging costs are relatively high. So to look at them from a more tactical basis, you do need to see more buffers starting to build in. So the value is starting to get built in, but we would really want to wait for a bit more backup in yields before we are convinced enough to re-engage from a long side. Having said that, we do think that risks of more monetary easing at this point of time are higher than what market is pricing them to be. So there is some value in the front end of the curve. As I said, there are some concerns on the fiscal side in the very near term. So we are not really concerned about the structural fiscal trend in India. But in the very near term, there might be some pause in the fiscal consolidation. That makes it that much more harder for us to engage meaningfully from in the belly to long end of the curve. So all put in perspective, we do see some scope of further steepening in the curve, and the front end still remains the portion of choice on the curve right now.
Okay, looking out for further steepening. Prashant, take me inside what you're seeing with the rupee right now as well. Do you think it's accurately pricing what could potentially be a perhaps prolonged trade and tariff war with the Trump administration?
See, on the rupee, it is very difficult for us to expect a meaningful outperformance of the rupee against its own trading basket. Against the dollar, of course, a lot will depend on the DXY trend itself. But to the extent we expect some true alpha to come out of rupee, I don't think the conditions are fully aligned as yet. We think market is underpricing the extent to which the higher tariffs can continue in India. So apart from the agri-related trade issues and the Russian oil issue, there are probably more geopolitical underpinnings to the whole tension right now. And it may not resolve, that may not get resolved very quickly. So we do expect that growth headwinds might be entrenched for a longer time than the market is anticipating. We do not think that there is a risk of uncontrolled or a dislocated weakness in the INR. The FX reserves are at a very strong level. The central bank will be in the market, but we do expect that the path of least resistance for the INR is to be weakening against its own trading basket. And even in the eventuality that we might see a quick resolution of the trade talks, beyond a sharp knee-jerk reaction for a short term, we still find it difficult to to see or envisage a stronger rupee because the central bank will come in and intervene on the other side as well. They have to recoup some of the lost FX reserves. The forward book will likely continue to roll off, and that will present a persistent dollar bid in the market. So all in all, we still think that on a trade-weighted basis, INR is still in for a spell of further underperformance there.
Okay, so talk to me about the RBI playbook then, because as you just said, some of these growth headwinds may perhaps lead to further monetary easing as well. The ET reporting today that the RBI might not change its stance, but just adjust a little bit. What's your view on where rates go from here and why?
Yeah, so you rightly pointed out when you refer to the media reports. I think it's difficult for us to see a change in stance so soon again in India. So stance probably stays at neutral. But as the future growth numbers, the real activity indicators, they start showing a meaningful slowdown. We do think that the potential of monetary easing comes back on the table. It's probably not a story for the next 2 to 3 months, but as we head into late fourth quarter, we think the current trajectory implies that there'll be enough weakness in headline data for the central bank to consider at least 1 to 2 more rate cuts in this cycle. So to pinpoint the exact terminal policy rate is a bit tricky for now, but we think, maybe a headline or the policy rate at 5/4 to 5 is quite possible in the country.
And to what extent do the GST changes also influence that rate trajectory?
Yeah, so on the GST front, we do expect that the changes in GST will provide some boost to domestic consumption as the consumption taxes get lowered. We think this should boost the growth rate by 0.3 to 0.5%. But overall, this will not be enough to arrest the slowdown in the growth momentum that we are going to see. So irrespective of the domestic consumption boost that may be provided in the near term, we still think that central bank will be in a position to deliver more easing. And this is especially true in the environment of an extremely benign inflation outlook. We think inflation continues to stay close to the bottom end of the tolerance band that the central bank has. We probably have already seen inflation bottom out, but it is again difficult to see a meaningful sequential pickup. Again, base case do mean that headline numbers will be slightly higher next year, but from a pure sequential basis, we do not see a meaningful pickup in inflation. So again, central bank should be in a reasonably good place to deliver more easing.
So, okay, if we do see the RBI perhaps moving 1 to 2 more cuts this year, as you suggested, but also the reality that we could see a prolonged trade stoush between the US and India, you've also flagged that there are growth headwinds to come. Walk me through your view on the S&P upgrade then, because you've said this wasn't necessarily a surprise, and you say there might be more upgrades to come as well. So square that circle for me, and what will it take for India to reach A territory? If so, how close are we?
Yeah, sure. So the growth headwinds that I have been talking about, they are more near-term and relatively temporary in nature. The S&P upgrade was really a result of the more structural upliftment that we have seen in India's macroeconomic environment. The headline growth numbers, even though it has been moderating, they have been staying at a relatively high level. The real activity indicators have been strong. Rural consumption has been doing well. The fiscal consolidation's trajectory has been very strong. The current administration has done a great job on that front. The external balances have been looking good. The current account has moderated. It is stabilizing at a very manageable level, the current account deficit that is. And even though net FDI has shrunk, a lot of it is down to the fact that outward FDI has picked up, which also has very positive structural underpinnings to it. So if you look at improvements on the macroeconomic side, you look at the infrastructure improvements, some of the reforms that have been delivered, all of those have led into the upgrade that has happened. If you talk to Indian policymakers, they believe that probably more upgrades are due. And it's difficult to argue against that when you look at the broader trajectory that we have seen in India. So as you pointed out, the upgrade was not a surprise. S&P had India on a positive outlook for more than a year now. So this announcement was due at some point of time. And should this structural trajectory continue, irrespective of the near-term trade tensions that we are seeing, we think that more upgrades can be delivered, not only through S&P, but through the other rating agencies as well.
So, of course, you're looking at this through the lens of EM debt as well. It has been suggested to me that the current geopolitical and economic headwinds may actually mean that we could see reforms being accelerated in other areas. Yes, there's a big push now on the GST. Yes, there's also a big push now on diversification and growth. But, Prashant, from your perspective, what are the other areas where there is opportunity to see more of that reform taking place, particularly the places where investors should be watching most closely?
No, absolutely, Dan. You have pointed out a very critical aspect right now. So while we are looking at near-term growth headwinds, if there is a silver lining to this, is that maybe this is the catalyst that India needed to push through or bring back some of the structural reform story back on the table. So it had probably been pushed back to the back burner for a while. And this is probably exactly the catalyst that was needed for it. So GST reforms have already been announced. I think, as I said, that should provide a good boost to the domestic consumption story. Beyond that, there are probably a couple of clear areas where we are looking for more measures to be announced. One thing is probably a relook and a more concentrated look at some of the production-linked incentive schemes that the government had earlier rolled out with mixed success. We think it's high time that some of those are revisited and probably in a more selective and more targeted fashion. But most importantly of all is what we'd be looking towards in the area of the R&D spend by the private sector. India's corporates, the R&D spend has been very low compared to global standards. And that is probably one of the key links why you still have doubts about the sustainability of the macroeconomic improvements that have come through. So if these incidents do lead to some sort of government push, which can incentivize or at least put on a better trajectory the R&D spend by the private sector, I think that is something that would be very exciting for investors like us.
Okay, we watch and wait. Prashant, thanks so much for joining in today. Appreciate the conversation. That's Prashant Singh there from Neuberger Berman. And that's all we have time for today on Inside India. Keep watching CNBC. Access Middle East is coming up next.